Hey everyone, me Kevin here. I just lost lots of money, but it's okay, I'm with you. Yeah folks, so this week was absolutely brutal, and last week was pretty tumultuous as well, but it was actually an okay trading week. I made over $9,600 trading EHang after a short seller blasted the company. I traded down a few $100s on OGI, but I made some good money back on Fisker, so net last week I'm up over $9,000, which is really exciting on the trades, but this week was different. So yeah, my trades, I only trade with about $30,000, and on my long holds, well, I park a whole lot more money, and this was not a week for trading, it was a week for losing. Yes, folks, it all started Monday afternoon when CCIV and Lucid, the suits, got greedy. A lot of the suits at CCIV and Lucid saw, hey, we have so much public investor demand, why not dilute our public shareholders, change the valuation and base price for our company, and boom, make an announcement that basically halves the stock's value on a revaluation. Well, no surprise, some big tendies evaporated. That's okay though. I'm diamond handing this one because I'm in at 19 and I'm still profitable on this one. And now I'm very excited about that, but I'm more excited about them actually rolling out vehicles later this year. More on Lucid in another video. Now, on Tuesday, we had a real warning shot. We had 15 minutes of hell starting just a couple minutes after the opening bell. The market started for about 2 minutes and then plummeted. Now, what's interesting is we had 15 minutes of hell, but the market basically went straight up for the rest of the day on Tuesday. So unless you were around Tuesday morning, you didn't get to take advantage of the tendies. That is buying very low by buying the dip. Now, Wednesday turned into a day of reflection, a day a lot of us thought, damn, I wish I could have bought more shares yesterday. Well, fortunately for the people who wanted to buy more shares on Wednesday, they got another opportunity because, well, we had Thursday. See, Thursday was disgusting and gut-wrenching. On days like Tuesday and Thursday, we typically feel some pretty strong emotions. First, we get weirdly glued to our screens. We can't help but continue refreshing our portfolio, hoping it goes up. Second, we feel stupid. We feel like we made a mistake and we should just sell and start from scratch because it'll stop the bleeding, and if we stop the bleeding, the pain will stop. Third, we sometimes start feeling this like lightheadedness. It's really just a burning sense of failure that makes us slightly weak, basically. And it creates this tunnel vision that as soon as we try to get up and like go get a cup of coffee or get a drink or whatever, we end up just turning around and going back right to our screens and checking for another catalyst or portfolio update, hopefully looking for a green shoot that just doesn't end up coming. Yes, well, all of this is literally toxic. People often ask me, they're like, Kevin, why is your program called Stocks and the Psychology of Money, which is linked down below. You could use the coupon code down below, of course, for. And the reason is we are our own worst enemy. See, we get seduced by this pain that I just described. We paper hand and become sissies and sell out, but it's not our fault. This is actually human nature. When you're getting hurt, you flee. That's called fight or flight. But what's fascinating is you can't actually fight in the stock market. When you're getting hurt in the stock market, there's literally nothing you can do. So when nature says fight or flight, but then they take away fight, all you have is flight. And people generally, especially newer investors, don't have well, there is another option, and that is just stay here and keep getting beat up. But that is not a natural response. It is not a natural response to stay and keep getting pummeled and pummeled and pummeled. Humans are not designed for continued suffering. Humans are designed for minimizing suffering. So paper handing is not your fault. It is nature's wiring of your human brain that makes you feel that way. And it certainly doesn't help that other humans with these same feelings feed into this with comments like, don't catch a falling knife, it'll just keep getting worse. And all these fortune tellers tell us, don't worry, we'll tell you when the bottom's here, and then they never tell you when the bottom's here. Instead, when the bottom came and went, they tell you, don't worry, there'll be a double dip, so that maybe they could be right the next time, but they just never are. In fact, that's exactly what happened in March of last year. Folks, all this stuff is designed to rob you blind. So how do you solve this? In my opinion, there's only one way. You eliminate distractions and you surround yourself with winners. There's a reason in the Stocks and Psychology of Money group that I don't allow the posting of loss porn, and I also don't post gains. Why? Because usually you end up getting people who post gains on these YOLO bets or losses on these YOLO bets that either went really right or really wrong, and they make everybody else feel like they're a loser for having a normal portfolio that has some diversity to it and can grow wealth over time. It's usually the people who post like a 400% gain on a $200 investment they made, which is like congratulations, you made money on your $200 investment. That's not life-changing, but congratulations. Or the people who are posting the loss porn, which basically just reiterates why you shouldn't be investing in the stock market, which is also very stupid. It's all bad. It's coalescing fear into a water cooler of cancer. That's what it is. You got to stay away from this garbage. It makes you feel bad looking at people's gains, and it doesn't make you feel good about the stock market seeing people get wiped out. It's emotionally stupid. And this is why I call my program on stocks and the psychology of money, because folks, we are our own worst enemy, and we get attracted to the stuff that is absolutely wrong to be attracted to. After all, why is it that when an appraiser tells me my property is worth $680,000 instead of $725,000, despite the fact that I have multiple offers on it, that I would somehow be convinced to sell it for $680,000? I'm not. See, in real estate, I laugh, I roll my eyes, and I call up a different lender to get a different appraiser. Because when I have multiple offers, I understand market value. Just because somebody has an opinion that is different from mine doesn't mean I have to agree with them. And the same is true in stocks. Just because the stock market is being an emotional crybaby doesn't mean I have to part with my shares. After all, last I checked, I didn't lose any ownership in the companies I owned. It's just some stupid market that decided those shares were worth less. But I still own the same number of shares I had last week. Instead, actually, this week I added, and we're about to talk about Ark Invest, but let me go through this first with you, just so I can prove to you that when I say buy the dip, I actually buy the dip, and I don't just talk about buying the dip. This week, in reverse order, so I'm starting on my Friday, I just basically scrolled up through my stocks and money alerts, and I'm going in reverse order. So the alerts I sent out this week, which it was a dippy week, so some of these are up, some of these are slightly down. That's okay. In the long run, I'm very confident in all of these plays because I'm buying companies that I'm excited about. I even added a new one, which was Airbnb this week. I'm going to be going deep into this one this weekend, and who knows, maybe we'll start a larger portfolio in that one. Anyway, I bought 10 call contracts at $45 for NEO. I paid $20,300 for those, expiring in January 2023. I bought those when NEO was trading at pretty much the bottom, around $44.50. We'll see how earnings go. It could trend down more after earnings if earnings misses on Monday. So a little bit of risk there. 100 shares of Airbnb for a cost of $185 each, so $18,500. $27,500 in a Tesla call option, $700 call option for March 17th, 2023. Earlier in the week, I also put $39,000 into NEO, $43,955 into Enphase, about $100,000 into CCIV, diamond handing that one, $34,300 into Tesla, $35,000 into Matterport. At the big dip on Tuesday, I ended up almost perfectly timing this. I didn't get the exact bottom, but as I saw the support level form, I put my buy order in. I knew this was going up at this point, so I just put a market order in. I got my market order executed at 640.90. Had I put in a limit, I would have probably put it in at 635, and I would have literally sat there and watched Tesla run away from me. So I got about $96,000 of Tesla at 640. Happy about that. Did buy about $54,000 of API, and when we're all said and done, that means during this bloody week of blood and crashing and fear and toxicity, I ended up injecting $469,000 into my portfolio over the last week, and I did not sell a single stock this week. I also invested, well, with the exception of a very, very brief trade in and out of GameStop. I also invested $1.6 million into a private deal this week, which means I put over $2 million into investments this week. But don't get me wrong, I did lose money. I'll go ahead and just pull up a quick spreadsheet that I made. It's easier to see it all consolidated on one page. Generally, I don't check my portfolio because it just makes you feel bad when the market is red. But these are my before and afters. On my JP Morgan, that's the only one that I couldn't actually find an easy way to see what my before balance was, but I know it was over 15. Could have been like 15.2 or 15.3. But anyway, if you can see the percentage losses there on the right. What's interesting is even though my portfolio is down about 3.8, I'm still injecting money into this because I'm very confident when we rebound, which I'm patient. I don't need this money for probably 30 years, honestly, probably at this point ever. I've got enough of a real estate portfolio, so it doesn't matter to me. I don't need to paper handout. It's not going to change my life to sell any stocks. It's just being transparent. But what's interesting is you'll notice that the biggest swings in my stock portfolio were actually on Webull and Robinhood, and that's the only place I hold options because I can't hold options at JP Morgan and M1 Finance. This is one of the reasons I do like shares a little bit better because I do have less volatility. Now, sometimes that means more money on the up, but it also means less loss on the down. So that's kind of a quick little update there of the portfolio. Yeah, obviously that means my portfolio is down a pretty sizable amount, but that's okay. I mean, if we look at February 19th to now, pretty much everything's down. But I'm okay with that because I'm adding to stocks at discounts that I wasn't able to get a few weeks ago. In fact, in the last 2 weeks, prior to this week, I shaved or sold about $1 million off my portfolio to pay down margin, which really enabled me to go shopping this week, which was perfect timing. Obviously, you can't always time it that way, but it works. But wait a minute, what's wrong with me? Why would I go shopping when it hurts so much? Well, it's because when you buy, guess what you don't do? You don't sell. When you buy, you don't sell, and this is why you keep adding to the positions that you are seeing pain in. Now, why would I not hedge my portfolio? Why not try to buy some puts or try to hedge just to make sure when my portfolio declines, I don't lose as much money? Well, there's a simple reason for this, and this is where Ark Fund comes in, Ark Invest. See, Ark Invest is not a hedge fund, they're an actively traded ETF, so they do not hedge. And because they're not necessarily, I mean, they might have certain ways that they hedge, but they're not publicly hedging like a hedge fund does. They're not a hedge fund. See, the interesting thing about Ark is Ark, when prices go down, they just add. Cathie Wood adds a ton of money to positions she's down in. But the market, people generally don't like that. When the market is falling, they want to be able to look at their fund manager and go, oh my God, are you please tell me you're protecting us. Please tell me you've hedged. That's the point of hedge funds. See, right now, Bloomberg has had multiple headlines this week about billions of dollars flowing out of Ark Invest funds, which when billions of dollars flow out of Ark Invest funds, they actually have to liquidate some of their positions, and small stocks like Nano Dimension end up getting plummeted along the chaos. And see, that's one of the unfortunate things about psychology in our marketplace. People see Ark Invest falling, and they panic, and they sell, and they get out of Ark Invest. When Ark is actually doing the right thing. They're doing the perfect thing that they should be doing. Adding to their positions, doubling down on their positions at cheaper prices. It's brilliant. But hedge funds don't do that. Hedge funds, instead, they call up their clients and they're like, oh, don't worry, look, we had these put options in place and look how good they're doing. Just don't leave. Hedge funds are all about trying to keep their clients, whereas Ark and Cathie are actually going to outperform, in my opinion, these hedge funds for the long term and by a lot by buying these dips and not being so overly focused on trying to hedge all the time. Because when you hedge all the time in the good times, you end up spending so much money on premiums and tying up extra collateral or extra money that you could be investing trying to hedge. In my opinion, I'm right there with Cathie and Ark. Now, I have to say, I disagree a little bit with an email that they just sent out during the recording of this video. This email came out about 37 minutes ago, and I have to say I'm a little bit disappointed in this email. This email came out at 5:15 p.m. Pacific time from Ark at Ark Invest. They say it's Friday, February 26th. Hello, Kevin. And I'm a little frustrated that they say that Workhorse is up 24%. They talk about how Workhorse traded down 47% on Tuesday and then went up on by 24% on Thursday. So they give you the feeling that there's a green arrow here of 24%. I kind of personally think this is a way of trying to stop the bleeding for Ark Invest funds, because if you actually go over to Workhorse stock and you just type that in on Google, you'll actually see that over the last 5 days, yeah, Tuesday you had an over 40% sell-off, but that 24% they're referring to is right here, where the stock went up roughly 22%, but it also quickly sold off those gains, and it's barely up 4% from that point. Yet in their email, they're showing that it's 24% up. This is incorrect. This is not true. I'm a little frustrated by that, but personally, I believe this is the kind of email that goes out because, well, first of all, maybe they needed regulatory approval for this email and they were a little bit behind on updating this. Who knows? It seems a little inconvenient. But the point here is simple. Look, hey, Ark and Cathie Wood don't want to see people outflowing, and after all, they shouldn't. See, I agree with Ark and Cathie Wood, and I follow the same strategy. Buy the dip. Does it hurt to look at my portfolio and go, my portfolio is down $3.8 million, even though I added $469K to it? Yeah, but I know this is what made me a lot of money when I did this in March of last year. Every time the market was painful, I added. Now, it's very, very simple to try to trade these. I personally just like buying into these dips. Buy into these dips and wait for those green shoots to come back. That's my personality. Now, there are going to be awesome trading opportunities coming up. Obviously, we've got OCGN and Fisker that are running like crazy. We'll see. We had a ton of peak media attention at Fisker today. CNN, well, Fisker was on CNBC yesterday. They had a CNN interview. They had a Fox Business interview. They made the rounds. So if peak media fades on Fisker, it's possible Fisker could go back to earth. We'll see what happens. Otherwise, maybe Fisker will continue to run. Even though they went bankrupt in the past, they have a small market cap relative to CCIV, so it could be interesting. The point here, though, folks, buy the dip. Dime in hand, and guess what, folks? I'm not leaving. Thanks for watching.